definitive guide to cryptocurrencies. My name is Jason, and I want to let you know that anyone who follows this YouTube channel by clicking the subscribe button, then clicking the notification button, will automatically receive my buy and sell trade alerts from the YouTube channel. So as you can see, in the last 2 months, I've returned a 78% profit on $1,014 invested. The point of this is to show a small account that has a small amount of money invested every month can quickly grow into a large portfolio trading cryptocurrencies. And so the way it works is once you click the subscribe button and the notification button, YouTube will automatically email you every time I put out a new trade. And also, recommended to the side of this video is this easy to follow cryptocurrency model portfolio. It's a 40-minute video where I show you the tools I use to actually buy and sell Bitcoin and other cryptocurrencies. So again, today's video is a total review of what cryptocurrencies are in the big picture, and I'm basically reviewing someone else's guide from mycrypto.guide. This is a great free resource that all of you should visit. Look below in the text below this video for a link to it, as well as everything else I'll mention in this video. But what I'm going to do is go through his guide. I'm going to give you my input, and I'm also going to pull up live charts of the different currencies and other related visual media to help understand this cryptocurrency world a little bit better. So here's a quick table of contents. And so this video will be considerably long, and I highly recommend you can also click the add to watch later on the right side of the video, so you can save this video and finish it later. And if you're already wondering what's in it for me, the publisher of this video, I want to say that first off, my main goal is to get a very big YouTube following. So I'm really hoping you'll subscribe to get my daily video, which comes out around noon Eastern every day, Monday through Friday. In that, again, is a free, completely free trade alert where I trade the top cryptocurrencies. I show you the model portfolio position size, how much capital I'm investing into each position, why I'm doing it. We have the stop losses, the profit targets, the trade videos, and the trade alerts, all available in this Excel sheet. And again, below this video, you can expand the comments and click to this Excel sheet right now. It's a Google Excel sheet that automatically fills the profit loss in real time with a nice Google Finance add-on. And I'm sure you're still wondering, okay, so what's in it for you? Yes, I do have a paid product. You can also find the link to this below. But there's no reason to buy it until you're seeing profitability, until you're making money with cryptocurrencies. The only difference in my paid product is that I have text message alerts instead of just YouTube alerts. I have email updates with a lot of written instructions. Those instructions are at the bottom of each YouTube video. You have direct access to me when you're a paid member. And the only content I'm not publishing to YouTube will be trading brand new currencies that have tiny market caps, where we're using 1 to 0.5% portfolio positions, and ICOs, which is a totally different platform, and how to invest in those is not even covered in this 40-minute getting started video I created. This 40-minute getting started video tells you A, where to buy Bitcoins, B, how to transfer those to an exchange, 3, the best software to use to actually trade the Bitcoins. It's not usually the exchange. It's a third-party service where you can connect multiple exchanges and trade them all from one platform. And then 4, this video covers where to get the best cryptocurrency news and the daily trading volumes. And you'll find that my strategy is to follow the money. Wherever the most money is pouring into it, that's where I'm putting my attention. Okay, so let's go back to the guide. Okay, so this guide starts off talking about how for years everybody sat back and thought of cryptocurrency as a Ponzi scheme some kind of bubble similar to the dot-com bubble, the next pet.com. But after the price went from 1,000 to 2,000 to 3,000 to 4,000, once governments started creating their own coins, once Vegas has its own coin, once the banks are starting to add Bitcoin to their platform, and are even starting to mine the coins, that's when the average Joe retail investor has woken up and they're starting to realize this may be something bigger than just a fad. This could be like buying into the internet back in the 90s when it was just first getting off the ground. It was just being used by the government and it was just starting to explode. Remember when it was dial-up, the web, all of this stuff seems so bizarre to me, even as a young kid. And I'm 32 years old, but I can remember when the internet was first coming out, it seemed so abstract. So hopefully this guide will help you have a better visualization of what this is and what it could turn into eventually. So that is my summary of his overview, and I do highly recommend you read this on your own time as well. So let's go into chapter 1. What are cryptocurrencies? So he makes a really good point. We think of the US dollar as this dollar bill in our hands, or a $100 bill, or pennies, and all this real money. But when you use your credit card, there's no physical money being changed between hands. It's just a ledger in an Excel sheet in a database. And so the first big point is that you have to start looking at cryptocurrencies as real money. If this phenomenon is going to really take off, one thing has to happen. Cryptocurrencies become everyday money. And that is really, at the end of the day, that's what has to happen for these prices to be supported and for them to blow into much higher prices. If what all these cryptocurrency investors think, this will become a mainstream use of money, and Bitcoin could hit $50,000. This is the number one resource I use, another free site, to gauge how the market's doing. Bitcoin traded in the last 24 hours $1.8 billion. Last week it traded $3 billion and others traded $2 billion and $1 billion. And so you can see this is not just some kind of flimsy currency. This is turning into a very highly invested investment that's growing at a very quick pace in 2017. So his point in this opening is that 90% of all money doesn't really exist except on a bank's servers. And so he goes over the risks. The main risk is that central banks print money, they loan it out at very low interest rates to their buddies, other big banks. And then those banks loan it out to companies and small-time people like you and I at 3, 5, even higher interest rates depending on your credit. So it's not really a fair deal, and as these governments get in more trouble with bad investments, usually from banks who get bailed out, everything's just going into these huge amounts of debt, and they're creating money at very alarming rates. So it doesn't take a genius to realize if they print out trillions of US dollars, that same $20 an hour you've been making for the last 10 years is not going to have the same spending power. And so here's Bitcoin over the last year, from 800 until it just began skyrocketing to 2,700, crashed down to 2,000, and ran up to 4,000. I was able to buy it down here in the 2,200 range recently and sell up here at this 4,300 range. And right now, I have limit orders to catch it during a crash and a one order right up here. If this breaks 4,500, 30% of my model portfolio will follow this, because quite often when these currencies break a high, they have these shoots up, and those are great opportunities to buy it. Also during volatility and crashes, that's a great time to pick it up when it's sold off for 30 to 50% of its recent high. So while Bitcoin has a very specific method for creating new coins, other fiat currencies don't, and it's hard to trust any small group of individuals to not be greedy and to not take advantage of it. So that is one big benefit of Bitcoin. And so if you're looking for a precise definition, then cryptocurrencies can be defined as a digital currency in which encryption techniques are used to regulate the generation of units of currency and verify the transfer of funds, operating independently of a central bank. Now it says the term cryptocurrencies can be misleading, as some of the projects I'll be discussing in this guide aren't currencies. Some are assets, some are platforms, some are businesses. For the sake of accuracy, I will simply refer to them as cryptos. So that's important. The idea of the blockchain, which is what we'll talk about soon, this whole concept of what gave birth to the idea of Bitcoin, is now being taken to lots of different scenarios, well beyond currencies. But what you will see is that all of the leading currencies right now that you'll find trading the most market cap consistently are all acting as a currency. And so perhaps there are opportunities to replace centralized technologies with decentralized technologies, and I hope by the end of this video you'll understand what that means. But my money is behind the ones that should turn into real commonplace currency in the world market, and I think that's where the big growth opportunity is myself. Okay, so a lot of people like to call Bitcoin the gold, Ethereum the silver, in terms of comparing it to other metals, I guess, that you can invest in on the stock market. But this document argues that this technology is far more useful than gold or silver, and that the idea is a lot bigger. What these guys have stumbled across is a better way to do accounting, a better way to share data, a better technology than having a single centralized system. And he notes the different values that are specific problems for cryptocurrencies. Security. In a moment, this whole idea of security will make a lot more sense. So he says that if 51% of the Bitcoin servers around the world were to team up, they could hack the Bitcoin algorithm and basically steal money or do something bad to the Bitcoin world. And he goes on why that wouldn't be likely, because people who own the computers and servers have a lot of money invested in hoping that it will go up, and that it'd be very hard to do much damage for that. Whereas individual governments can go do whatever they want in terms of creating new currencies or new money into their currency, and thus they have a lot bigger risk. And he talks about some fires happening and this and that. I think the real security issue is really just people. We can't trust people in governments compared to a simple algorithm. But the argument is, what if the central bankers got together and decided they wanted to destroy cryptocurrencies because it was bypassing their banking buddies, it was bypassing taxes, it's letting illegal drug transactions go on? What if they all teamed up? One, they could simply find all these servers, deem it illegal, and just go in there with machine guns and take these people out, which is a big risk that I really worry about for the entire cryptocurrency world. Because right now, people are getting away with they don't classify these as money, and they don't classify them as a security, although that's slowly changing, and they have come out saying that ICOs are now being deemed as securities. But there's no real easy way to track it. Normally the feds can just log into the bank accounts, and which are all in a central server, and see what's going on. But now that everything's going decentralized with Bitcoin and these cryptocurrencies, they really can't tell who's who and what's what. And in a moment, I hope to really make it really clear what a wallet is. Like, what's a Bitcoin wallet, and how do you hold your money, and how do you get access to it? How could someone steal your money? So we'll talk about that in a moment. Okay, transparency. Almost every crypto is open source. So that means you can see the code, the laws that cryptocurrency rules by, and how it can have votes and all kinds of stuff. Think of it like a government, and the people who either own the most of the currency or run the mining systems to make it possible get to vote on different items and agendas that are happening in these currencies. So they are evolving. They have a source code that you can see, but they can be changed. And so there's a lot of interesting history behind that, which has created Bitcoin Cash and Ethereum Classic, spin-offs of the original, of people who are not happy how the governing was happening on these two main coins. But at least you can see how the code will work until it gets changed, and then you can see how the changes are implemented, and you can see the voting process. So it's a little more democratic and fair in comparison to, say, the central bankers, where we really have very little input. We see what they're doing. We get to watch all these speaking engagements and try to read between the lines, but it's really, totally out of our control and in the hands of a very few small elite group. Immutability. So this is about basically changing the transaction history. Right now, we trust Bank of America that our $10,000 will still be $10,000 tomorrow. And when we send $1,000 to someone else, that someone else will receive it, and it's not going to be lost overnight. We also trust that this network ran by these banking centers won't lie, that they're verifying each other, and that no one's just adding zeros to their bank accounts, which would be totally unfair. So the whole idea behind Bitcoin is that every transaction in Bitcoin comes with a ledger of every transaction that's ever happened for everyone in the entire network. And now you don't have to bring your photo ID to create a Bitcoin account. It's just a number. That's your mailing address. That's where you can send money to, and you can create as many addresses as you want for free, and the only thing protecting that is a very long password that hopefully only you know. So if you write it on a piece of paper, that password should be very safe. It's a very long password, and as long as you use lots of different symbols, it's extremely hard to hack. But say you save a copy of the password on your computer and somebody gets it, then you're really in trouble. Or say you lose your password. You only had it in written form and you lost it. So this is something that makes people very nervous about Bitcoin. But the whole point is that nobody knows who owns which account, and nobody can pretend they have money that they don't have, because all of our transactions are held on these millions of what are called Bitcoin mining computers. And so anybody can go buy a fancy graphics card, an NVIDIA or an AMD graphics card, at least back in the day. Now the competition for Bitcoin has become very difficult to mine, but you can still mine Ethereum and many other currencies. And essentially what these mining systems do is they compute each transaction, verify it's legit, and then improve a transaction. And so you can make money as a Bitcoin miner by providing a computer that has the Bitcoin software on it, and it sits there and it waits for orders. It fills the order, and that is how Bitcoin can create new coins. It rewards the people providing the technology for performing the transaction calculations. And so every single sale of a Bitcoin or a partial Bitcoin has the entire history of the entire Bitcoin blockchain. So that's why it takes so long for Bitcoin to process a sale. It takes, well, at some points it was taking several hours. Now they've recently been creating new technology to make this a lot faster. But the catch is, the faster it happens, the easier it is to hack the entire network, the easier it is to make the easier it is to basically take advantage of the system. So that's the big idea that came from this whole birth of cryptocurrencies. The idea that we don't need one server who knows what's right and wrong. We all know what's right or wrong. So the problem is it costs a lot of money to compute that. And as Bitcoin has grown, it's become more and more difficult to compute this huge history of transactions. So since then, other currencies have come out and said, well, hey, we can just take part of the transaction history, a random portion, and do this computation much faster. So we have like Dash, Ripple, Monero. There's all these new currencies coming out that are Bitcoin Cash. They're all a lot faster at the transaction computation. But that point, that's what makes these coins so appealing, is that there's no cheating. You know, imagine playing Monopoly and one player gets to loan himself money and pay it back later for free. That's not really fair. And that doesn't happen in Bitcoin. And that's why, if these coins can make it to mainstream, Bitcoin can suddenly be worth a lot more than $4,000 a coin. So, all right, let's continue. Okay, global accessibility. Try to get, you know, I'm not saying any of us are outlaws, but for whatever reason you need to get $100,000 out of the country. Good luck doing that if anybody's after you, or if, let's say, we have a financial collapse and they start freezing your US dollars. You know, it seems like crazy talk, but if you study history, there's far crazier things that have happened. And so with Bitcoin, as long as you have your address written down, which is just a number you can put on a piece of paper, and you have your security code, you can walk across state lines, country lines, and still have access to your Bitcoins. There's thousands of ATMs where you can go and cash out money right now into whatever currency you want. And this is growing at a very consistent rate. So you can see the growth of the different companies creating these Bitcoin machines. It's not at every corner like your Bank of America or your Wells Fargo or whatever it is, but this is just the very beginning. You can see this is starting to take hold. Okay, then we have speed and price. Bank transfers take 3 to 5 days. You're going to get dinged $20, $25. These banks have so many hidden fees on every little thing you can possibly imagine. And Bitcoin is getting rid of that. Now you can transfer someone money for a fraction of the price. Usually it's 0.15% of 1%, which is almost nothing, and sometimes it's absolutely free. And you'll see soon that a lot of the cryptocurrencies coming to market are designed to replace companies like PayPal. You know, as a merchant, if you sell anything, you're going to pay at least 1% to the credit card company. Depending on the risk of your company, it could be 3, 4, 5%. So now we have all sorts of different new coins coming out that are going to allow you to process for 0%, to transfer money to your friends for 0%. And that's because it's possible with this blockchain technology. It's not possible through a bunch of banks and credit card companies who have, they have investors, they have huge amounts of money, they've got CEOs getting $150 million a year. They can't do that with free transactions. And they sure can't do interbanking wires instantly like a cryptocurrency can. This is a quote from the guide. From a purely financial perspective, it not only allows you to conduct trustless deals across the globe and lower any associated fees, but opens up new markets which previously suffered from institutional corruption, unstable currencies, and poor business practices. This is only the beginning. New cryptos are appearing on the scene with vastly improved capabilities. Automatically settle futures trading, automated supply lines, and allow machines to purchase products and services from each other as the need arises. This may sound outlandish, but keep reading. Chapter 2, How It All Works, Consensus and the Blockchain. Okay, so I've kind of teased us about this a little bit, but now we're going to dive into it. Okay, so real quick, here's a graphical visualization of blockchain. The big idea is that we're all connected together and we all share the entire database as one large network. There's no one central server who has the data hidden from us. Here's another visualization. Centralized, everybody goes here. Whoever has access to that point has a lot of power. Decentralized, we have all these nodes and no single centralized system. So this may take more time to compute transactions, but the trust that you have on the system is a lot more powerful. And so as we're going to see, this simple concept that we're visualizing right here could potentially wipe out a lot of technology that we all live on today. Okay, so this first paragraph says that centralized organizations spend large amount of money maintaining their security. Despite this, they are still vulnerable to outside forces, but especially vulnerable to inside forces. If someone has the right keys, they can abuse their power for their own benefit. With cryptos, this becomes irrelevant as nobody has all the keys. Now, real quick, anybody who's been following this knows that there has been plenty of security problems in cryptocurrencies. There has been some $100 million initial coin offering where all of the money was stolen, or a great deal of it. And the currency ended up voting to give it back to the people who lost it. And that created a big stir. And it actually created a new currency, Ethereum Classic. So there's been plenty of hackers stealing money raised by different new currencies. And there's plenty of stories of people having their accounts hacked and losing their money. So having your password online is a big risk. There's a lot of security issues to really protect yourself, especially as you start to trade bigger amounts of money. So security is not completely gone, but it has been vastly improving over the last year. Okay, so he goes on to imagine a simple bank where people can deposit their money for safekeeping. The bank writes down all the transactions in a ledger to keep track of everything. Unfortunately, a clever thief breaks into the bank's office and makes some changes to the ledger. So when they go to withdraw their money the next day, they somehow have more money than they deposited. The bank checks his ledger and everything seems in order. Now imagine a second situation where we have a bank with 11 branches. None of the branches trust each other, so they come up with a system. Each one decides not only to keep a record of their own transaction, but sends a representative to every other branch to independently write down every transaction their colleagues make. This way, if there's a dispute, the branches can compare their ledgers and decide by majority which one is correct. But there's still a problem. When the representatives are on their way between the branches to compare ledgers, they are attacked by thieves, and the ledger of more than 6 branches are changed, so they add an additional step. At the end of every page of the ledger, the banks will put all the values of the transactions from that page into a complex equation, and write down what they get in a document for safekeeping. At the end of the next page, they will add up all the values again, but also use their answer from the previous page. So how does this help anything other than making things more complicated? Now, when a band of thieves attack the representatives, they not only have to change the entries, but make sure that the changes they make still give them the same answer when they're put into the complex equation. This takes the thieves a long time, several weeks in fact, long before the point the bank realizes something is wrong and take out one of the many copies of the ledger. There's actually one more thing which makes the system even safer. To stop the bank from colluding against their customers, the branches are offered a reward every time they agree with the majority of the other banks. If they are the minority, they are fined. It turns out to be much more beneficial for the branches to play by the rules than try to break them. In the next section, we will see how this analogy relates to blockchain, the system of ledgers, the difference between consensus methods. At this point, he mentions a video by Ivan where he says, "The Byzantine General's Problem." And this is where they're going to talk about the difficulty of creating a decentralized system. And I will include a video to this so that you can access that. So at this point, I'm hoping you're starting to understand the big idea between the cryptocurrencies. Now what we're going to get into as we move through this is a little bit more of the details of how it works, and then we're going to start talking about the different coins and the uniqueness of each coin. What makes them different than Bitcoin? That's the big question. Why make another coin? And why is Bitcoin staying the same way it is, or slowly making adjustments? Okay. In the previous example, we saw that there were competing branches. The nodes, or bookkeepers in cryptos, can be thought of as competing branches. Every time they fill out a page in their ledgers, they cross-reference it with everyone else's ledgers. The blocks in the chain can be thought of as the pages. Finally, the complex equation they have to solve with the values of the transactions on the page is called hashing, and is much harder to do in reverse, as the thieves were attempting. So what is the benefit of being a node? That's the miner. Well, every transaction that is carried out pays a fee to the nodes for processing it and ensuring their security. The fines we talked about in the bank analogy depend on the consensus method, of which there are many. Here is a quick visualization of a Bitcoin mining farm. Just huge amounts of money are being, look at this place right here. Just insane. It's quickly becoming the biggest computing power in the world. And, you think of maybe the US dollar being backed by gold, which perhaps really doesn't have a lot of use. Well, the Bitcoin technology is backed by a tremendous number of high-speed graphics cards. And that's why stocks like NVIDIA, AMD, and STM have just been skyrocketing. People are now buying airplanes to fly to the manufacturers and distributors of these graphics cards, buying out the entire inventory of every card they can get their hand on, then bringing them to these warehouses where they have just gigantic numbers of these cards. And you can see these guys are wearing jackets. That's because they want the coins, or these cards, they need to run cold, and it's very, very hot. These things pull anywhere from a few hundred watts per card, so the electricity cost is just enormous. Meanwhile, China is giving nearly free electricity because they want to have their hands on everything, really, but they're putting a lot of money in Bitcoin, while Russia's really heavy on the Ethereum. Okay, so proof of work was the first method ensuring consensus and is the most widely used method. Essentially, a node will have a transaction come through known as a block reward, and it reviews the ledger, it reviews the algorithm at the bottom of each block, and it says yes or no. And if it has the wrong answer, which is determined by what 51% or more of the blockchain says, then they get fined. If they agree with it, they get the reward. So with this method, it's very difficult to cheat blockchain. And as the history goes forward, it becomes more and more expensive for each transaction to occur. A lot of mining operations pool together so that they can have a bigger power source to process these transactions. And so I'm not going to get into the great length of how different cryptocurrency mining takes place. With my analysis, the minimum it would cost to build what they call a rig is about $1,500. And with the way things are going right now, you can mine Ethereum or Zcash, would probably be the top two, and get your money back in around 6 months. But you're going to have a great deal of research figuring out how to do it. You're going to have a hard time finding the graphics cards. You're going to need 6 of them and likely build it yourself. If you try to buy it from someone who's pre-built it, your $1,500 investment will cost more like $4,500, which is insane. It would take over a year to get your money back. But after that, it can become pure profit. So for those of you who do want to get into mining, there's a ton of great content out there, and I may develop some content on that. For now, the CryptoTrader product will focus on trading the top cryptocurrencies and investing in very exciting new currencies or cryptos that are coming out. Okay, so the pros of this system of accounting is that it's very hard to cheat. And it now gives a reward for those doing the auditing of the transactions, so that essentially the coin grows. The more transactions that are happening, the more miners can make, the more it'll drive demand for mining, which creates a bigger and bigger network for Bitcoin. So if central bankers and normal currencies were more trustworthy, this wouldn't be such a big pro. But right now, you can't trust them, and you can trust Bitcoin. So that's why we've seen Bitcoin price skyrocket. The cons is that this uses a lot of energy. One transaction requires the same amount of energy as a household for an entire day. Lower confirmation times than other methods. Low transactions per second capacity. Currently it's around 7 transactions a second for Bitcoin, while Visa and MasterCard can transact, I believe it's 3,000 to 4,000 transactions a second. Computing power tends to centralize in parts of the world where electricity is cheap, like China and Russia. Cryptos that use proof of work: Bitcoin, Litecoin, and Bitcoin Cash. Proof of stake. In proof of stake, there is no mining. Instead, one node will be chosen and simply process the transaction without needing to solve any complex math puzzle. The other nodes will verify the block. In order to penalize any attempts at cheating, the nodes must lock some of their currency in a virtual safe, and this stake will be fortified in any funny business if any funny business is detected. This system is called staking and can be thought of as similar to mining for POW, but without the large electricity bills. The more currency you stake, the more likely it is you'll be chosen to create the next block. Therefore, the more you have to lose if you try and cheat. So this is a faster method, and it can do many more transactions per second. The cons? Well, the big con is this as secure, and probably it's not. Now, we haven't seen something like Peercoin or NXT be completely taken advantage of this, and they still don't trade a whole lot of volume. However, Ethereum is moving to this method, which is a very big market cap in the crypto world. The advantage for this also is that it's creating an entire business where you can make money by having the most currency, so you're buying the currency and holding it, or mining it and holding it, so that you get first priority to earn the transaction fees. And they've made the accounting system faster, so you can have a higher profitability mining this coin. As for the consumer, now you can make a transaction instantly instead of having to wait hours like you do with Bitcoin. Proof of importance. Users must stake a fixed amount of their currency to become a node. So this is that same idea. It's good for the value of the cryptocurrency because people have an incentive to buy and hold it. Very scalable. NEM is the current currency using this method. And then there's another spin-off of this same idea, delegated Byzantine fault tolerance. The shareholders of this coin, which came up with this idea, NEO, get to elect nodes. The nodes have a certain amount of money they must put up to take that node. But once they become a node, there's no more important node that just because you have more money in it, you get more of the transactions. And there's no mining. Once you have the node, you get the transaction fees. So you're not competing like you do with other coins. Pros: fast confirmation time, very high transaction speed per second, 1,000, close to the Visa levels. The blockchain will shut itself off before it allows a fork, meaning a focus on consistency as opposed to liveness, which is important when trading assets. Low transaction fee. Currently free. Cons: as of yet untested at a large scale. This is a very small cap crypto. Delegated proof of stake. This is currently used by BitShares. Witnesses, those that confirm the transaction, are paid fees, and delegates who make decisions about the transaction fees, block times, and size, amongst other things. Both of these node types are elected by a majority vote. So this is the con for this is it's requiring a lot of participation to get going. Tangle. The consensus method deserves a category of its own and isn't even technically a blockchain. The Tangle network relies on every user acting as a node. Before a transaction can be confirmed, the user must validate 2 or more previous transactions. After you have done this, another user will validate your transaction in order to make a transaction of their own. In this way, rather than a chain of blocks, we have a net of transactions. This allows for free, instantaneous transactions and scales extremely well. However, there are still questions about security, and so oracles are needed to serve as a kind of supernode and police station. So IOTA is the concept behind this, and compared to blockchain. So same concept but taken to an even extreme level. Smart contracts. Now this is a very exciting topic. The next advancement in blockchain is heralded to be smart contracts and the use of dApps. You may have heard these buzzwords before, but do you actually know what they mean? In a normal contract, you have 2 or more parties agreeing to some terms. If I do this, you will do this. If you fail to do this, then the transaction will be canceled. These contracts are legally binding, so if any party breaks the terms, they can be taken to court or prosecuted. Smart contracts make this whole process a lot easier. Instead of terms being legally binding, they are bound by the blockchain, meaning that once the contract has been signed by all parties, the terms will be carried through no matter what. So Ethereum was the first big coin to create smart contracts. DApp stands for decentralized apps. These work in conjunction with smart contracts by automating the job of middlemen, such as a broker. A DApp acts as the broker, so it's basically just Now with Ethereum, you can write a contract so that when you agree to the terms, once those rules play out, you get paid or payout. And there's no having to worry about the other party fulfilling their end of the bargain. So we'll get into that in more detail as we continue down here. Digital assets. This is where things get really exciting. Smart contracts and dApps by themselves are limited to dealing with the digital realm, ones and zeros. However, some projects are attempting to bridge the gap between digital and physical realm by taking things such as commodities, title deeds, and products and putting them on the blockchain, assigning them a digital certificate which is legally binding. So let's look at an example. Currently, buying a house requires lawyers and is a painful and lengthy process. By issuing legally binding digital title deeds and implementing smart contracts, it will be possible to buy a house as easily as you can order an Uber. This also opens the possibilities of partial ownership of real estate, art, cars, IP, etc. in a very intuitive and liquid way. Use cases. Now that we have looked at what cryptos are, what their underlying value is, and how they work, let's discuss perhaps the most important part. What can they be used for? Storage of value. This is the most commonly associated use of Bitcoin. Many media outlets have referred to Bitcoin as digital gold, and most of the hedge fund analyses I have seen rely on this concept for their valuations. The idea is that because Bitcoin has a finite supply, just under 21 million Bitcoins, the value will go up as demand arises. Actually, the circulation supply of Bitcoin is falling as people lose their private keys or Bitcoin is burnt. However, these analyses are oversimplified. Currency. Without getting too philosophical, everything relies on the people's faith in the Federal Reserve. Bitcoin is the first global currency that does not rely on a single country's money supply or economic health. While cryptocurrencies are volatile, currently, as the market cap increases and the trading volume increases, the volatility should slowly decrease. And this is indeed the case, although we are still seeing some mammoth crashes, which has been my main trading strategy. And if you have not followed this YouTube channel yet, I hope you will, so that you'll start to get our daily trade alert videos. But the fact that it is volatile is very good for investors who have faith in the long-term ability of cryptocurrencies to grow and buys the dip. Crowdfunding platform. So this is one thing smart contracts have been used. ICOs, initial coin offering. Hundreds of millions of dollars are being raised this year on ICOs. Here's just a few. This may not be up to date, but just this year, Filecoin, Palo Alto, California, oh boy, another hedge fund center, raised $252 million. Tezos, another San Fran operation, $232 million. Bancorp Protocol, $152 million raised. Status, $99 million. 10x, $58 million. So these are all coins that you could have invested in before they hit the exchanges, and some people have made an awful lot of money getting into the right coins early. Now I will say that right now there's a new coin launching every day. 99% of them are going to lose all of your money, so I really don't recommend investing in 99% of all ICOs. In our product, we will risk between 0.5% and 1% of our portfolio in the world's biggest ICOs, because we believe if they're willing to put up $100 million before it even works, this is just for white papers usually talking about the coin they're going to make, then they probably are going to have a pretty hypey launch whenever it hits the exchange so that all their investors can cash out. And if they do go have success and start getting real world use, then you can get these for a penny, and all of a sudden they're trading $100 and you've made a 10,000% return. But again, even if you only followed the biggest ones, you'd be lucky if 1 in 10 was a great success. So that's why it's critical to do very small position sizes on ICOs. Okay, decentralized services. Okay, decentralized services basically is saying that they think almost everything you can imagine could be replaced with a decentralized network versus a centralized network, and by doing so, the cost of the product will go down, monopoly will be dropped, and the people who use the product will be rewarded with the product itself. So let's just read it. Now comes the really interesting use case and where the future of cryptos lie, in my opinion. And for me, I'm not sold on this idea yet. Right now, I'm mainly interested in the coins that provide a currency value that will be used as money or help the process of transferring money. But listen to this. In much of the same way that Airbnb disrupted the accommodation industry by decentralizing the industry away from a small number of hotels and B&Bs to a large number of individuals, blockchain looks to decentralize everything else, from leveraging spare computer power, see Golem, and hard drive space, see Siacoin, Fatcom, and Neo, to crowdsourcing IP addresses for VPNs, a very topical issue given the talks on net neutrality and the Great Firewall of China, see Mysterium, and advertising, see BAT. The blockchain looks at simultaneously increasing security and productivity, reducing risk of monopoly, reducing costs, and lowering or eliminating barriers of entry. So these guys want to replace Google, Facebook, and Amazon with blockchain. I mean, that's kind of the idea of that. So, just a quick break. Who is this going to piss off? This disruptive technology is going up against central banks and gigantic internet Goliaths. So it is going to be a very interesting war. I don't think they're just going to let Bitcoin take over and blockchain take over all these established industries. So we'll see. Internet of value. You may assume that the industries that are up for disruption are just online services, but cryptos are now looking at bridging the gap between the physical and digital realm as discussed in the dApps section. They can pull this off. If they can pull this off, then we will see them take over every aspect of our lives. Blockchain is everywhere. It becomes common practice to issue legally binding certificates of ownership of physical goods. We can improve liquidity across all asset classes, vastly reduce legal disputes and costs, improve supply chain and logistic management, integrate systems across sectors and countries, allow partial ownership of previously indivisible assets, obtain and analyze big data on a scale not seen before, and that is just the beginning. See Neo and Stratus. Okay, so step one, let's just get Bitcoin, Ethereum, and Dash accepted at Walmart. That's when we're going to really see a big move in the price of cryptocurrencies. I think all these other concepts are going to be possibly very small ideas for the next couple years until we can at least get the main idea working here. That's my opinion, at least. Okay, now I'm going to skip to the most popular crypto section. First we have Bitcoin, the father of cryptos. Bitcoin is considered the most secure of the cryptos, partly because it has been around the longest and therefore has the most commercial proof of security, and partly because of the amount of computing power and number of nodes providing the protection is the largest. It has recently implemented a software update allowing something called SegWit 2x to increase the size of blocks, the pages in the banking analogy, from 1 to 2 megabytes, which basically doubles how fast you can process it, and allows the creation of side chains, which free up room on the main blockchain and can add extra functionality such as instant transactions, easy swapping between cryptocurrencies, and even smart contracts. So this is going to put a lot of pressure on Ethereum. Risks, the miners have been fighting about all sorts of things. A lot of them wanted to keep it old school, hard to mine, slow, The new school of thought is we need to compete with Ethereum, otherwise it's going to become more useful, it's faster, it's cheaper, it lets you create contracts. Another risk, currencies with superior technology may overtake in the future, has been very slow to adapt changes. Government may enforce regulations to prevent the conversion of fiat to Bitcoin. And that could happen to all of them. Probably will happen. It's going to be very crazy if it does. Advantages, first mover advantage, largest network, most volume. Ethereum's meteoric rise came about due to the hype over smart contracts. It recently had a very large amount of ICOs on its platform and a lot of interest from the developer community. It is a Turing-complete language, meaning that pretty much any kind of program can be written on it. It aims to be a platform on top of which smart contracts can be written. And there is literally an ICO happening every day right now. People are really taking advantage of this, and the only way you can buy the ICO is by having Ethereum. So you have to buy Ethereum, and then you can convert it to an ICO, which is flooding in with money right now. Risks. A repeat of the DAO hack on other software developed on the platform due to the room for error and unfamiliar programming language. So DAO is the one that lost some $100 million from a hacker on the Ethereum language. Slower uptake due to unfamiliar programming language. Superior tech may overtake it. So every coin that comes out, someone comes up with a better way to do it. Not too long after. Advantages. Broad range of smart contracts, largest following amongst blockchain developers, arguably the best developer tools, large corporate support through Ethereum Enterprises Alliance. Ripple's one we traded and made a nice profit on. The first crypto backed by the banks, which is a bad sign because we're trying to get away from the banks, but it has a very specific use case, providing liquidity in Forex markets between banks. Note, this does not mean they intend to replace the Forex markets, but supplement them. Consensus method. Ripple Consensus Protocol Algorithm, RCPA, consists of a few trusted nodes run by banks. Although it doesn't provide the same level of trustlessness of other consensus methods, it is suitable for its intended use, which solely deals with transactions between banks. So the banks are simply trying to increase their ability to create transactions between themselves. This one has the least risk of being shut down by the governments, and it is a coin I like and have been buying at crash moments and seeing good profits from. Bitcoin Cash is a hard fork created during the controversial scaling debate. That's when Bitcoin couldn't figure out how to start doing faster transaction speeds with less electricity cost. It decided to tackle the scaling problem in a different and more immediate way to Bitcoin by increasing the size of its blockchain, the pages in the banking analogy, from 1 megabyte to 8 megabytes, which doesn't do anything to speed up transaction but reduces backlogs while retaining security. In order to adapt itself to the large change in computing power experienced over the first few weeks, it implemented an emergency difficulty adjustment which allows it to change the block difficulty much more quickly than Bitcoin. This coin went from $300 to $1,000 in the last 2 weeks. It's only been alive for 2 weeks as of 8/28. Crashed back to 500. We bought it at 500 and we're sitting on it with a small 10% portfolio position in our account. Lower popularity to Bitcoin, but it's very new. Very China-centric, centralized. A lot of mining happening in China for both Bitcoin and Bitcoin Cash. Doesn't allow any extra functionality and shows no willingness to change this, but it's very new. The emergency difficulty adjustment may be open to abuse. We see fluctuations of miners appearing briefly to take advantage of a lower difficulty and switching out when the difficulty changes only to switch back when it readjusts, leading to instability in block times and profitability, which is good. That should create a lot of volatility for us as a trader. Litecoin has been like Bitcoin's younger brother, and here is Litecoin, by the way. If you got in just back here for $3, it's now trading at 62, so that's 20 times your money. I'm currently sitting to buy it at this resistance level and this resistance level when it has a crash, if it has a crash. I also like to buy coins when they break highs and let them run up, show a little bit of pullback, and get out. In between, I don't touch them normally. Okay, Litecoin has been like Bitcoin's younger brother, similar in most respects, but due to lower expectations, is able to change quicker, such as the SegWit implementation, popular in China. Confirmation times are 4 times faster than Bitcoin. May be able to synergize with Bitcoin. Talked about as the silver to Bitcoin's gold. Has a face to the company, Charlie Lee, which allows it to create direction more decisively than Bitcoin. XEM, NEM. Okay, here's a chart of XEM paired against Bitcoin. In my platform, you can't buy XEM with US dollars. You would have to convert US dollars to Bitcoin and then Bitcoin to XEM. You had the opportunity to get in this at, I don't even know what that is, a tiny fraction of a cent. And it's made its way up to, and that's because this is related to Bitcoin, which is now at $4,000 a unit. But this is multiplied in value considerably and pulled back right here to the middle. I'm currently not trading this coin. NEM also has its unique consensus algorithm, proof of importance, which inherently promotes network usage as a currency rather than a storage of value. A clever, if complex, method of retaining security and efficiency while promoting usage has been established, and there are a lot of upcoming updates to the protocol in the works for added functionality. Allows multi-signature wallets, which can serve as extra security for things such as joint accounts or financial services. Risks, less straightforward to understand the underlying technology than other cryptocurrencies, which may inhibit uptake. Advantages, inherently encourages network usage. Multi-signature wallets, consistent updates to technology, active in establishing partnerships. Dash. Okay, Dash went from a penny to 12 cents, back down to 4 cents, and currently is trading at 9 cents. So this has been a very successful coin. As of August 28th, in the last 24 hours, it traded $68 million, so it is somewhat liquid. Not compared to Bitcoin, but for a small-time trader, it's definitely plenty liquid. Dash stands for digital cash and really aims at bringing cryptocurrencies to the consumer market by allowing very fast transactions required for industries such as retail. It has also implemented a treasury system where 10% of the transaction fees are pooled towards funding further developments of the protocol in a self-governing system. Risks. As with other currencies, as opposed to platforms, assets, and tokens, it is a highly competitive space, not anonymous despite its claims. Advantages: very fast transactions, low fees. A focus on user-friendliness and consumer uptake. IOTA. Here's the next one. Here's one that did a starting price of $1, it crashed all the way down. Sorry, it opened up at 58 cents, crashed to as low as 15 cents, and then rise to $1, and is currently trading at 85 cents. It's trading about $23 million a day. IOTA is a unique among the cryptos as it doesn't use blockchain technology but a Tangle network, which allows instant free transactions with the intention of creating a machine economy. With the rise of Internet of Things, different machines will be able to communicate and pay each other for products or services that can supplement each other. In line with this, IOTA is developing its own hardware and a ternary CPU especially for this. However, there are still many questions about the security of the network. Risks. The creators have implemented a training stage until the network is large enough that security is not such a concern. Requires specialized hardware. The market it's aiming for doesn't exist yet. The nodes have nothing at stake for attempting to attack the network, which is a red flag for security. Very large potential market for an advantage, truly unique technology. So those are the pros that have provided some interest in it. NEO, often touted as Ethereum of China. NEO, just in June, you could have bought for $1.25 and it hit a top price of $50. So you could have almost made 50 to 1 your money if you had bought into this one early. I'm currently not holding any positions, but I'm very interested in this currency. And I'm looking for a $20 entry or a plus $50 entry. So again, if it crashes to 20, I would likely pick up a 10% portfolio position, and if it were to break 50, I would put on a 10% position in expectation of another shoot up like this. While NEO uses smart contracts and provides a platform for the creation of dApps, it has an added clear focus of connecting the real world with digital and supports many common programming languages such as C, Java, Python. It aims to achieve this by combining legally binding digital certificates of assets with digital identities and smart contracts to create what they will call the smart economy. Risks. It is yet to be seen how their unique consensus method will work in practice. Low initial gas supply and speculation may lead to very volatile gas prices, bad for business who want to know how much a transaction will cost them. Poor communication from the development team. Advantages: great transaction throughput, 1,000 per second. Low to no fees. Multiple language support. Addresses a need from a legally compliant approach. Almost impossible to hard fork. Great community support. Network effects. Easy access to the Chinese market. Monero. Now this one really took off recently. XRM is the ticker for Monero. Went from $13 to $137 this year. Even lower if you go back, $6 back in October of last year. And it's skyrocketing. I missed this one. I'm looking for a big crash to pick it up. Monero's main focus is on privacy and true decentralization. The development team has prioritized the improvement of their privacy technology over marketing and user friendliness, which allows it to focus on its niche. It can bundle transactions together in such a way that provides anonymity to the users. While the obvious implications are that Monero will be used for less than legal transactions, many will see value for privacy, especially in light of current developments around net neutrality. Monero has created a protocol where ordinary consumer computers can still remain competitive while mining, as opposed to Bitcoin, which requires specialized ACIS computers. It should also be noted that Monero transactions are 25 times larger than Bitcoin's, which may prove difficult to scale going forward. There will be no immediate issues with this as the block size scales dynamically, but the main issue becomes bandwidth. Questionable market size, smaller room for growth, not scalable. Advantages: network effects, anonymous transactions, good decentralization. If private transactions become increasingly important, its market size will increase. So recently it's taking off. OMG has been on a steady rise. from as low as 50 cents to now just under $10 at $8.50. Amigo is a DAPP smart contract blockchain. It's part of the parent company Amis, which is a payment gateway provider aiming at the Southeast Asian market. If you know anything about payment systems in China, you will have heard of WeChat Pay and Alipay. The premise is that everyone has access to a smartphone, and allowing you to pay everything from bills to street vendors with the swipe of your phone is not only convenient, but has become the predominant form of payment in China. Amis aims at establishing the same system in Southeast Asia, and Amigo is its attempt to incorporate cryptocurrencies into the system. The positioning is unique for a couple of reasons. First, it allows people access to secure funds without the need for a bank account. In Southeast Asia, only 27% of the region's 600 million inhabitants have a bank account. Secondly, it is working towards facilitating payment in fiat as well as cryptos, and making the whole process easy to understand and set up, which is crucial for vendor and customer adoption. Could this be the key to mainstream cryptocurrency usage? Very early stages, no proven track record yet. The marketing has been very slick. As a consequence, there has been a lot of hype, most likely overvalued, could be said about most cryptocurrencies, to be fair. Advantages: many high-profile advisors, including Ethereum founder Vitalik, Lightning Network co-author Joseph Poon, and founder of Golem, Julian Zatwowski, in talks with the Thai government. Uniquely positioned in East Asia. So this is one I do want to get into during a crash. Next, Stratus. This ticker went from a half of a penny up to 6 cents. So that's a 10 times gain, and then crash back down to 2. Currently I have no limit order, but if it were to get near this level here, I'd likely pick up a 10% position. Also, if it were to break through this to 7 cents, I would also likely buy and hold, expecting another big shoot up. In between, I don't like to trade. Stratus aims to provide a platform for businesses to build their own blockchain solutions to problems as varied as supply chain management to the transparency of research publications, integrity and transparency. The integrity and transparency provided by the blockchain will allow greater control over complex systems such as supply chains and big data. Risk: less popular currently than other cryptos with similar objectives. Advantages: built on top of the Bitcoin blockchain. And now, after that, there's a few more, so if you want to go to the website, you can review those. The next video that will automatically play after this video is my how to trade cryptocurrencies, where I go over a lot of this stuff. So I'll still slide through here. Exchanges. I use Coinbase to buy my coins, and then I exchange them to Poloniex. There's a lot of options, but that's the method I like. And I'm also setting up a second broker for smaller coins, which I'll follow up with in a future video after I've thoroughly tested it and make sure it's high quality. But you can take your Bitcoins to localbitcoin.com to find someone to buy them for you. If you want to go local, there's local Bitcoin ATMs now. It's growing. And if you wish to continue reading this article, there's really a lot more. I made it about halfway through it and wanted to really give you a good understanding of the top coins and how they work and what the differences are, and give you an introduction to my service, which is a free YouTube channel where you get trade alerts of when I'm buying and selling the top coins. So thank you for your time. I hope you enjoyed this video, and subscribe to my channel.